Hey everybody, Smart Silver Stacker here. Welcome to another silver stacking live stream. Got plenty of stuff to talk about today. I want to kick it off with this report from the World Gold Council regarding central bank gold purchases in Q1 2023, because what we're seeing here is a continuation of the trend from last year. And we're going to break it down and take a look at the numbers. Got a new record set for Q1 for the start of a year for gold purchases. And then we'll get into some of the reasons why central banks feel the need to be getting into hard assets, because that is also an important part of this story. Hello to everybody in the chat. Hello, thanks for joining. I appreciate you tuning into this live stream. Hey, real quick, do me a favor before we get started. Do smash that like button. Subscribe to the channel if you haven't yet. Helps get this video out into the algorithm, helps spread this word about sound money. Now let's take a look at this report here from the World Gold Council regarding Q1 2023. So the notable thing here is that the purchases by central banks and other institutional buyers is still very elevated. Now, it's not quite as high as it was in Q3 and Q4 of last year, when central banks bought about 458 tons and then 378 tons of the metal. But 228.4, still a tremendous amount of gold. And you can see that this still dwarfs the Q1 number from last year. And this is, in fact, a record for a first quarter, a start to the year. And the records for the individual quarters go back to, I think, the year 2000. And so that is quite notable that in Q1 of this year, central banks are continuing to load the boat on gold. And, you know, the World Gold Council, they tell us in this report that they forecast that there will be continued elevated appetite for the remainder of 2023 among these institutional buyers, but they forecast that the remainder of this year, the total gold purchases by central banks will actually be lower than last. But that's just their forecast. I mean, keep in mind, we're only in May, so a lot of things could happen between now and the end of the year that might cause these institutional buyers to continue this flight into the safety that hard assets provide. And so I think it's very likely that 2023 could end up being another record-setting year, because certainly there are a lot of black swan events. There's a lot of things out there in the workings in the geopolitical climate and the global economy that could very well spark a flight into safety. As far as the gold accumulation, I covered this story in a recent video, but I just want to touch on this again, that China is one of the biggest accumulators of gold officially. Their official numbers, their official gold holdings increasing in April for the 6th consecutive month. And then look at this. This is very interesting. The Singapore gold reserves increasing by 45% in Q1. So very significant gold purchases in Singapore. I mean, a 45% increase in your gold reserves in a 3-month period of time. Just absolutely incredible. 45% increase. It's about 69 tons that they accumulated in the first quarter. So quite a bit of gold going to Singapore. Now, we're going to get into some of the news surrounding the debt ceiling. I think that's one of the things that could be causing some of this flight is all the debt, the huge, massive amount of debt that the U.S. has accumulated. So the stories about the debt ceiling do tie into this. Real quick, if you're interested in being like a central bank and stacking some gold, SD Bullion has, what do they got? They got these 1/10 ounce gold Britannia coins on sale. Now, there's something funny about these I wanted to mention. So if you're in the mood for fractional gold, you can get this. This is the Charles version of the coin, and that's kind of what I want to comment on. It seems interesting to me that Britannia's, and soon I think all the Commonwealth countries, they're going to be switching their coins over to the effigy of Charles from the Queen. This is sort of the switch year. It's the year when you get, some coins with the Queen's face and some coins with the new King's face. They recently had his coronation, so I guess he's officially the king now. But I think it's really funny if you look at the 1 ounce Britannia coins here on SD Bullion that have the Queen's face. they're going for, at the lowest price, about $2,160. The ones with Charles, 2,115. So I think it's quite amusing that Charles seems to be that much of a detriment to the coin. People want the one with the queen. And, I mentioned this in a recent video that I wasn't so fond of the effigy of Charles. And Sean Fu, I guess, watched that video, and he left a comment that he'd rather have Krusty the Clown on his Britannia coin. So I thought that was pretty funny. But just an amusing thing here that these coins with the king not fetching the premium. And if you want to get some gold just at a good price without any royalty on it, they've also got these Perth mint bars. So anyway, check those out with the link down in the description, sdbullion.com. Now, Janet Yellen has warned us that the consequences of not raising the debt ceiling could be, disastrous. That's sort of the story that we get out of the powers that be. The debt ceiling has to be raised. If we don't raise the debt ceiling, we're not paying our bills. Of course, the reality is that, the debt ceiling is so high and the debt level is so high. And the reason we need to raise the debt ceiling is because we don't pay our bills. It's because we keep paying them with a credit card. But one of the reasons that Yellen tells us that this impending catastrophe is going to be here sooner rather than later is because there actually was a deficit in the U.S. tax receipts. Or I'm sorry, not a deficit, but the U.S. tax receipts. So the tax returns, the amount of money the Treasury is getting from taxes, was lower than expected. And so this is creeping up on us very quickly. And when we're talking about the U.S. national debt and the debt ceiling, we can always take a look at the U.S. debt clock here. But I want to point out that, all this argument over the debt ceiling, this is all just political theater. I mean, there's a reason that they have us focused on this so much in the mainstream media. I mean, it's debt ceiling this, debt ceiling that. All of the conflict over the debt ceiling is nothing more than political theater, and they are going to raise this. I just want to point this out. I think I'm 99% sure they're just going to come down to the wire. They'll make some kind of a deal. The reason that they can't come together on this is that both sides, the Republicans and Democrats, the current president, this guy McCarthy, they need to save face. And so Biden, he just wants to hike the debt ceiling without having any kind of attachments to that. Just hike it, the clean bill, that's it. McCarthy says, he wants all these conditions. He wants cuts to this discretionary spending. But the thing is, nobody is talking about cutting Social Security. Nobody is talking about cutting Medicare. Nobody is talking about the $187 trillion of U.S. unfunded liabilities. That's all of the money that the U.S. is on the hook for all of these programs, federal pensions, military benefits, veterans benefits, and these core programs, the ones that none of these politicians will touch with a 10-foot pole because, they'll get kicked out of office by the voters if they do. That's where all the real spending is, and until they begin discussing making meaningful spending cuts, the debt ceiling is going to be a non-issue. It's going to go much higher. As far as the risk of a default, I think it's a little bit overblown. We could see some kind of a government shutdown, I suppose, if they come to an impasse and they can't reach an agreement. But, honestly, that would probably be one of the best things we could possibly do is, have a government shutdown, make everybody realize how little they actually, need most of this spending, how little it affects their daily lives. And there's no reason that there would be a real default. The Treasury could just prioritize payments on the debt. U.S. Treasury holders, they should get their money either way. But it is a little distressing that Janet Yellen comes out and tells us that there's going to be all these consequences of raising the debt, because one of the things that this tells folks who are holding U.S. Treasuries is like, hey, the only way you're ever going to get paid back for loaning money to the U.S. in the form of buying these Treasuries is if you get paid back with more borrowed money. That is essentially the message that is being sent here. And that means that you're going to get paid back with devalued currency. It's just the bottom line. So, the takeaway here is not that there's going to be this catastrophic failure to raise the debt ceiling. The thing that everybody should really be worried about is that they are going to raise the debt ceiling, and they're going to continue to borrow money, and then they're going to print the money and monetize all of that debt ultimately. Now, we are kind of also watching right now this slow motion train wreck of the U.S. banking system. I've got the 6-month chart pulled up of IAT. So this is an ETF that tracks regional banks here in the U.S. Now, if we go into something like the 5-day chart, if you really get into the minutia of it, you can see that we did actually have a pretty good recovery over the past couple of trading sessions. But then again, when you zoom out, you can see that that's just a blip on the radar, and this downward trend is still very much in effect. And this is likely another reason that central banks around the world are accumulating hard assets, because when they see the condition that the U.S. economy is in and the need for all these banks to end up getting bailed out. I mean, I think there was a study recently done. The number I've seen is 186 banks at risk of failure. I think I covered that study back in March in a video, but the point is, Fortune tells us $1.7 trillion in unrealized losses on all these bad assets on these banks' balance sheets. So they're going to be needed to do a lot of printing to take care of this banking sector eventually. I mean, it seems to be that the programs they've implemented, the BTFP among others, they have slowed down the collapse. So now we're just kind of watching the banking system fall apart in slow motion. But nonetheless, you can't stem the tide of these collapses, while the Fed is still hiking rates. And I want to talk about that a little bit here today as well. We did get the CPI numbers for April out recently, 4.9%. That's the year-over-year increase. I believe this was a little bit weaker than expected. And now everybody is talking about a Fed pause. And if we look at the CME FedWatch tool here, you can see now there is a 93.9% chance markets are anticipating of a pause in rate hikes at the next FOMC meeting the Fed will be holding on June 14th. Only a 6.1% chance of a 25 basis point rate hike. But look at that number. I mean, 4.9%. It's so crazy that things have gotten so bad now in terms of inflation that people look at this 4.9% number and they think that this is good. I mean, keep in mind that all of this inflation that we're experiencing is cumulative. I mean, first of all, the CPI does not accurately represent price increases. I think we're all aware of that. I can't think of anything off the top of my head that has gone up only 4.9% that I'm buying over the past year. I mean, the price of the vast majority of things I'm buying at the grocery store, online, at big box stores, whatever, it's all a lot more than 5% higher or 4.9% higher than it was a year ago. But the CPI has all these tricks within it to minimize these numbers. It's all perception control by the central banks and the powers that be and the folks here over at the BLS, and they have certainly massaged the CPI formula quite a bit over the past couple of decades. But 4.9% is not a low number. And again, this is all cumulative. These price increases continue to persist. And so, we've got high prices now. We've got Americans going into record levels of credit card debt just to try to make ends meet and pay for basic necessities of life. And prices are still going up. They're just not going up as fast. And so now the Fed is going to what? They're going to pause? Well, I mean, I do think it's likely that eventually we will see the Federal Reserve be forced to return to not just pausing, but cutting interest rates and stimulating and unleashing new programs, new QE. I mean, they've already kind of done that through the Bank Term Funding Program, but what I anticipate is coming is much larger than all of that. And this is going to come about when the amount of problems either in the banking sector or somewhere else in the massively over-leveraged U.S. economy, when we start to see problems really crop up as a result of these elevated interest rates. But I mean, obviously, these interest rates are not high enough to bring inflation down because we're still at 4.9%. That's still much higher than the Fed's 2% inflation goal. But, already there's a lot of talk of a Fed pause and potentially a pivot. And, if we see this banking system continue to collapse, I expect that that's exactly what we will get. And these inflation numbers, they're not ever going to get anywhere near 2%. Now, in terms of the 2% inflation target that the Fed sets. One of the things when inflation started to kind of tick up that we heard Jerome Powell talk about a lot was inflation averaging. So, he'd say, well, it's over 2% now, but it was below that for a while, so we're just going to try to get an average. And they use this as an excuse to keep monetary policy looser for longer. But you don't hear him talking about inflation averaging now. I mean, if we were to get down to an average rate of inflation after the past several years, I mean, you would need a significant period of time with rates of inflation below 2% to achieve that 2% average because the rates have been so high for the past several years. I mean, what do we need? Deflation, a reduction in the cost of goods. Now, as far as I'm concerned, that would be a good thing. But, listen to the Federal Reserve. They want to tell you that that would be the worst thing possible. Nevertheless, their monetary policies, which have created all this inflation, have imposed a tremendous hardship on your average American. And the other thing I want to say about this CPI number, this 4.9% annual CPI, is you got to keep in mind that this is against a backdrop of a tremendous amount of oil being released from the Strategic Petroleum Reserve. Jeff, the tameless troglodytic Tiger Thomas, $10 super chat. Thank you, Jeff. Awesome. He just says, thanks for sharing this information. Well, you're welcome, sir. Thank you for tuning in and for the support. I do greatly appreciate it. I better take those $10 that you just sent me and spend them quick before they're devalued further by the power of inflation. But no, I really do appreciate it. But you got to keep in mind that this inflation that we're witnessing over the past year, 4.9%, is against a backdrop of hundreds of millions of barrels of oil being released from the Strategic Petroleum Reserve, which has helped to keep a cap on a lot of these price increases. If you look at this chart here, back in April of 2022, we had 564 million barrels of oil in the SPR. And then if you go to April of this year, we're down to 367 million. So almost 200 million barrels of oil being pumped into the system in order to keep things low. But, you can see the SPR now has been cut roughly in half. So we have maybe, another year of doing that, and then we're out completely. Not to mention that we're on the verge of, World War III. I mean, I'm not really even going to get into that in today's video. I don't have any updates there for you. I mean, if you watch the news, you know that every day we're marching closer to open conflict with Russia and possibly also with China over Taiwan. I mean, at this point, it's basically like NATO has gone to war with Russia in Ukraine. Maybe I'll do a video touching on some of that in the near future, but it might be a good idea to keep some of this oil in the SPR is my point. But, clearly the SPR, the current administration, the powers that be, the politicians, they view the SPR as being a vote buying tool rather than truly being a strategic asset to be reserved for times of warfare and strategic necessity. And this has a lot to do with why we only have 4.9% inflation according to the CPI. I also wanted to take a look at the price action in gold today. You can see both metals relatively flat. This is following that CPI release. We've had really very little move in the metals. And I do think that that is telling. I mean, it appears to be a sign of strength in both gold and silver, if you ask me. Getting a lower than expected inflation number, it's kind of hard to say in today's environment how that might affect the precious metals. We live in this kind of strange Fed-driven good news is bad news is good news kind of dynamic, but both metals just kind of hanging out, hanging flat. I do want to reiterate, I know I've touched on this many times in previous videos, I do think there is the potential for a bit of a pullback here still. The commitment of traders information remains quite elevated. It looks like gold and silver perhaps are a little bit overbought. I know last Friday we saw that pretty sharp correction in both metals, but they rallied off of that pretty nicely. Maybe that was the floor. I don't know. I'm still a little bit wary at these prices in the short term, but, to me, it doesn't really matter. I mean, in the long term, I'm just trying to dollar cost average. None of this is financial advice, by the way. I'm not telling you what to do. I'm just kind of keeping an eye out for a big dip. But if we don't get one, I mean, eventually I'm going to have to resume stacking. And who knows, a year from now, I suspect that if we look back on these prices, they will look quite favorable and quite appealing. And the only thing we'll really be doing is kicking ourselves for not stacking more at these levels. But I'll tell you, if we do get a pullback, I am going to add some serious weight to the stack. So that's pretty much it for today, everybody. This may be a little shorter than some of the live streams I've done, but that's everything I wanted to cover. I do appreciate everybody tuning in. I'll go to the chat here real quick before we wrap it up. Glockman says, inflation is due to excess printing of the worthless fiat Federal Reserve note. Corruption Ponzi scheme to the moon. Yeah, that pretty much sums it up. AK Goldbear says, I must be crazy. Usually people buy gold and I sell gold. My God, what's wrong with me? Okay. Safe and effective. Yesterday, about 2 10-ounce Canadian bars. Oh, were those RCM bars? Yeah, those are pretty sweet. And then Glockman says, buy junk silver. No one wants a silver bar around too much counterfeiting. Well, I don't know. I still want silver bars and rounds. Get some verification equipment if you're buying on the secondary market, if you're concerned about that. Although you're not wrong. There's nothing wrong with junk silver. However, if you go to wish.com or, Alibaba.com, you might be surprised at how many counterfeit junk silver coins are out there as well. Anyway, thanks for watching, everybody. Thanks for tuning in, and I will catch you next time. Appreciate you being a subscriber here. Stay safe and happy stacking, everybody. Smart Silver Stacker, out.